Good afternoon, ladies and gentlemen. The standard cliche, it's fashionable to be late, but that's no excuse. I had a little technical issue starting a couple minutes behind here at 4:32 p.m. Eastern Time on Friday, December 28th. Welcome to our extra special final open discussion of 2018. For those of you who don't know me, of course, my name is Mike Chupka. I am the Director of Education here at PowerOptions and RadioactiveTrading.com. And welcome to the webinar. What we're looking at here is the one-year chart for SPY. Several presentations we've done in the past month. We've talked about how just about half of the months, 6 of the months of 2018, of course, were negative. February 5th through 9th, March 20th through April 5th, later hiccup in May, end of June, beginning of July, and then October, then November, and then December. We all know where we are. We all know what's happened. We don't know what's going to happen next. But what we're here to do first is we're going to review some of the favorite topics, and those favorite topics from 2018 that also apply to where we are now. We're going to take your questions as well, of course, moving on. So we're going to have an extended session today. It might last till about 6:15, 6:30, but I just want to start off with our review from last year, some of my favorite topics. Many of you might have remembered this one. February 9th, 2018, one of the only times that we did a special 35 to 45 minute presentation, other than what we're doing today, about the current market conditions before we did our open discussion. And we talked about something different. This was at the very end of that volatility crux, February 5th through February 9th, that steep decline. I'll just have to take a deep breath and relax. We've taken a hit. It is your money, but as the Hitchhiker's Guide to the Galaxy, and remember this was just a week or two, maybe a couple weeks after the SpaceX launch, and of course the Tesla was launched into space as well. Starman's Tesla display says, don't panic. So during that first 45 minutes, we cleared our heads. We talked about where we are, things that one could have done, things that can be done at the bottom at that time, that disastrous crash over a 4-day period as well. What did we discuss that day? We looked at the data of past corrections and the decline duration of a recovery. The cause of the February 5th through February 9th move, and we talked about our articles and power options for stock or portfolio insurance, ideas on puts on an index or ETF, and calls on the VIX for a portfolio hedge. Okay, now I'm not going to rehash that whole 45-minute presentation. You can go to powerup.com/webinars.asp, click on the Requested Topics tab, and scroll down to when that webinar was posted, February 13th, 2018, current state of the market and what investors like you want to know, to look at those specifics. But why I have this in as one of my favorites is because it led us into a deep discussion of this idea of purchasing VIX calls as a portfolio hedge. The idea is simple. The application not so clear. What do we talk about as this portfolio hedge? We're going to look to buy calls on the VIX, and we're only going to use a small portion of our portfolio, maybe 2%, maybe 3%, maybe up to 5%. I wouldn't do any more than that. Usually I'm about 3 to 5% as well. And what I look to do is I'll buy slightly out of the money VIX calls 1 to 2 months out in time that are around $1 per contract. But I don't do this every cycle. And there's a reason why. So my first approach on January 17th, remember the market was going up. We were still looking pretty good. VIX crept up to about 12. At the beginning of the year, it was around $9. Remember that? Now, I bought to open 21st February 14 straight calls at about $1 with 3 to 5% of my total portfolio. On February 5th, the VIX closed at 37.72. It was up $20. It had been moving up well. And then on February 6th, it closed at 29.98. So I missed the first gap. That's what's really tricky with this. So you have VIX calls in your account, you're looking to make a profit, there's that first spike, and a lot of times 30, 40, 50% of that initial spike might disappear the next day. It went up 20 points and then it dropped another almost 8 points the next day. So on February 6th, I closed half of those calls for about $7.25. Remember, I paid $1. But then again, February 7th, it fell a little bit more, but then February 8th, it gapped back up to 33.46, and I closed the other half for $9.90. Right away, you see something very wrong here. I had 14 strike calls. When the VIX was around 30, I closed half of those calls for $7.25. Shouldn't they have been at least 16? That's a key to remember. The VIX doesn't really perform like normal options. It doesn't take necessarily intrinsic value. It's based on a projection of the volatility futures themselves. So the strike prices don't react like a regular option you're used to that's based on an underlying security or shares of an underlying security. Okay? That's one of the keys to remember that's sort of difficult with this structure. But again, I missed the first gap, sold half. It did gap up for me again. I sold the other half, made out well. Now this was a hedge for my total portfolio. This isn't a strategy that I expect to be profitable long term. Meaning I just don't want to trade VIX calls with 60, 70% of my total portfolio and hope that the wins outpace the gains. I think it would have worked this year, but it wouldn't have worked in any other year leading up to this, going back to about 2014 or so. Now, at that time, February 5th through 9th, I had 3 bull puts open. All were near a 90% loss. We're going to talk a little bit about that later on. I had 3 calendar spreads. They're down about 60% each during February 5th through 9th. I had 4 married put positions. On average, they were down from where the market closed on February 4th to where it was at the 9th of only 3.8%. And I had 2 collars that were near their standard collars that were near their full loss of 4%. Sam, I'm going to get to your comment in just a minute regarding there. And Sam's just chiming in, as always, thankfully, to help me out here. He's into VXX and UVXY. I'm going to talk about that in a moment. So anyway, the gains in the VIX calls countered the loss on the bull puts, the calendar spreads, and the collars with some left over. So during that whole cycle where the VIX spiked up and the market collapsed, my loss was only about 3.5%, less than that as well. How? How is that gain? Yes, I had a $6.25 gain closing half of them, and then an $8.90 gain or so closing the other half. How can that cover 3 spreads losing 90%, 60% on a few calendars? And how can an average, it's about an average of an $8 gain on each of those calls, counter that? And it's because of position sizing. Each bull put spread only represents about 5% of the total account. Using about 2-point spreads on average, following my PowerOptions default search, the weekly bull puts. Okay? Same with calendars. Because I know in a bull put spread, bear call spread, any vertical spread, iron condor, butterfly, even a calendar, and in a shift of the market, a sudden unexpected event, I can instantaneously be looking at a 70, 80, or 90% loss. So I can't let those spreads, that portion of my portfolio, anything that could lose up to 70 to 80% of its maximum value in the position, represent more than 4 or 5% of my total portfolio. So I could lose on all 3 without the VIX hedge and still have kept 85%, 90% of what I started before I made those trades. Okay? As always, 50% or so was in the married puts, and some were already bulletproof, which had no risk on the trades. Okay, but what next? We got that first approach. I bought the VIX calls when the VIX was low, when it was at 12 or so. Could have bought them when they were at 9. The VIX spiked, but it stayed high for several weeks, as it is right now. It did not settle back down to the $15 range, $14 range until mid-March. Luckily, at that time when I saw that trigger, I bought April 20 calls. Why did I go for the 20? Well, it was out of the money, and those are the ones that were closest to about $1 that weren't too far away. So I bought the 20 calls, and then around March 23rd. This was the trade war talk, the tariff talk against China and everything else. Fear in the market. The VIX went up to about 25. I think it was on March 23rd. So I sold all of the April 20 calls at 290. But I didn't buy the calls back after February 9th. I didn't buy new VIX calls after February 9th. I did not buy new VIX calls after March 23rd. Why? Because they are too expensive, as were the puts. The VIX is not like normal options. It's not intrinsic. Once there's a spike, as we saw recently, it goes up to 33, 34, or 35. You could see the 40 strike still priced at $2. Whereas before, when it was down at 12, the 14 strike was at $1, the 16 strike was at 10 cents. Okay? And in the money ones is as well. Paul says, yeah, the contango is difficult to predict. It absolutely is. If you're using VIX calls as a hedge for your portfolio, when the peak is hit or that sudden move happens, you pretty much have to get out then. Even if you expect it to move up more, you can't risk it falling back quickly as it has. It's a good idea to sell half. I like to sell half, especially when it covers my entire cost, leave half open with no cost or no risk, and I can still get some extra out. Waiting after that initial spike, even 1 day, 2 days, or 4 days out could result in too little return to hedge the portfolio. And you'd say, oh, well, the market is recovering, so the VIX would be falling down. That's not always true either. A couple times this week, after we saw the big spike in the VIX, yes, the major move the other day, on Wednesday, the VIX fell as the market went up. But there were other days after the big fall in October and in November where the market was still down, but the VIX went down as well. It's not always a relationship in that fashion, depending on the fear factor that's still out there. So what can you do when they're too expensive, when you're still worried about needing a market hedge? Well, if you feel it will settle or move back down, you can take advantage of the higher volatility in the volatility index, but you have to be vigilant. So for example, when I sold out of the calls here, if I felt the market was going to go down, this would be a decent time to do bear calls up near the peak, 40 to 42, 38 to 40, 35 to 37. Sounds really high, but would have been a reasonable one, only 1 or 2 point spreads, which only represent 3 to 4% of your total portfolio or less, maybe 2%. So as it falls, you take advantage of that. But I don't want to keep doing it. I want to wait till I hit another bottom, $15, $16, $14. Look to buy calls again. When you get the spike, get out. I didn't do anything here. Bought calls here. Broke even here, not a gain. Bought calls here, broke even. Bought calls here, profit. Bought calls here, profit. Didn't buy calls here. No, I'm sorry, I did. I bought about 2 calls here at, I think, the 26 strike. Some profit, okay? But this whole time in here was break even to a loss. In 2017, essentially this would have been a 2018 break here, but in 2017 there were little hiccups, but I lost the money that I put into the VIX calls 8 out of 12 months. 2 out of the remaining 4 months was BE, break even, and only 2 months in 2017 did I yield a profit on this VIX calls idea. Okay? That's what I mean by it is an idea, but it has its flaws. So, as we were talking about there, it's an idea. It is one way to go as a portfolio hedge, but as we've talked over the year, Sam has also mentioned his concepts of that's why he prefers to use VXX, the volatility ETF. Doesn't move as much percentage-wise, but it still has the moves that are counter market to hedge a portfolio. He also goes into shares and does positions on UVXY because it's easier to track. It's not based on those projections, or as Paul mentioned, the contango is difficult to predict. It does work in volatile markets. It saved me in February. It saved me in March. it saved my positions in October. I haven't opened any bull put spreads since October, but it really helped me hedge the calendars as well. So I think I'm missing a slide, and that's okay, but here's what we want to do. As I mentioned, part of this webinar is to sort of take out the trash. We've got about 45 to 50 now different webinars archived in the requested topics section, our open discussions for the past year. So at any time, you can go to powerop.com/webinars.asp. Anytime in the next few weeks, I'll leave them open until maybe through January. I'll send the text link to everyone. So it's powerop.com/webinars.asp. Click on the requested topics tab and then scroll down. And then you can review the talks on VIX approach for a portfolio hedge, Sam's contributions on UVXY as a portfolio hedge on these webinars, 3/26/2018. VIX Calls is now the time for bear spreads, 8/20/2018, managing bull put spreads, open interest, VIX Portfolio Hedge is a recent one. And then in May 21st, we talked about calendar spreads. VIX for buying the market. It's a different discussion, but it gave some insight into the performance, movement, and pricing of VIX and what's called flash trades as well. Okay, so the VIX Calls, portfolio hedge, always an important topic, always one we seem to talk about a few times, which is good. But I do want to say that subscribers to PowerOptions, of course, are going to see more on this going into 2019. Sam adds that UVXY split 3 times in the last 2 years, and that's why eventually he's had to go in and buy more shares. Okay. And Mark, regular contributor as well, Mark chimes in and just wants to know, Sam, personally, if you could chime in on this. Did Sam do a bear credit spread on UVXY when it was at 95 December 27th, 2018? So when it was UVXY was there, you said you did buy UVXY at 7, you did buy again at 64. Mark, Sam says no, he did not do a bear call spread on UVXY when it was at its peak. He's only in shares at this point. Okay. One of my favorite topics from this year during our open discussion is an education I received on diagonal calendar spreads, which I've been trading since probably 2005? No, 2004. Maybe 2004, okay? It was a great topic and a great situation that came in that I personally have never experienced in my own portfolio. I think this was back in May. Customer had a diagonal spread where the short call was in the money. Okay, what is a diagonal spread? Well, this is the standard profit and loss of a diagonal spread. I used OLLI, a married put position I'm in right now, as an example. I am in this calendar spread. Excuse me, I'm short the January 65 call, which I got for about 70 cents at one point when Ollie was around 62. And I'm long the 55 with a cost basis of around 890. I'm sorry, 920. The debit's about 890. No, the debit's, I'm sorry, 850. So 70 here, 920, bought the 55. That's in April. My apologies, that's in April. That's just an example of what the calendar spread is if some of you online are not familiar. The option went up, the stock went above the short call strike. And the customer was assigned early, a day or two before expiration. It was a Wednesday or Thursday before the Friday expiration. And he was assigned on the short call just as you would be for a covered call, but he doesn't own stock. He owns a further out call. In this case, it'd be in April. And we were assigned early on the January 65. And it was because the stock ex-dividend date was on Friday. So what does that mean? In theory, one would hope, just as one would hope with a bull call debit spread, a vertical spread, or a bull put credit spread, or a bear call, that if you were signed on the short, your broker would exercise the long to cover the short. Essentially, you'd buy shares of stock at 55 to sell at 65, and you're out of the trade. That's not what happened to him. And this is something I haven't experienced in this fashion. He was now short the stock on record of Thursday before expiration, and the ex-dividend date was Friday. The broker did not exercise his long to deliver the short. They said it was not the same expiration date. I guess if it was a bull call debit spread, they would have exercised the long. I don't know. I was kind of surprised his broker did that, but they said that the long call there wasn't the same expiration, so they didn't exercise it to deliver the short. So what happened? He had to pay the dividend. He was short the stock, long a call, short the stock on ex-dividend date, technically Friday morning, so he had to pay the dividend. And after that, the stock started to move up. Here's the problem. He's short stock and the stock's moving up. He's got a -1 delta on the short stock and only a delta of 0.7, even though he's in the money, but it's far out in time. He only had a delta of 0.7 on the call, and it was a large position. So he started to lose money on the short. He had to pay a large dividend on the position as well. Like I said, I've never had that happen to me. It was a great education for me personally to pay attention to that, even though I always do. Personally, I always know where my ex-dividends are. I use the PowerOptions portfolio to alert me if I'm within 3 to 5 days to an ex-dividend date or 3 to 5 days to an earnings date for something like a diagonal or a married put that I'm holding long term. And those alerts are emailed to me as well. Okay, why is this topic one of my favorite ones from this year? Well, because I learned something. I learn something every week, just as I hope you all learn something every week from me on our Friday discussions. But I learned something, but it gives me a chance to reiterate to everyone in attendance here and anyone who watches this recorded presentation the basic component of any options trade. Whether you're trading a diagonal, a calendar spread, a horizontal, a credit or a debit spread, an iron condor, a butterfly, a ratio, even just buying a call or buying a put, always know your rights and obligations for the position. In any spread, you have an obligation to do something. And that second option they're using to cover it might not cover it exactly. And it seems so basic, but I see so many investors get caught with the fact that how did X become Y? That shouldn't have happened because I was into options. Well, remember, any vertical spread, a bull put credit or a bull call debit, you may end up owning stock. How? Well, this is mostly for the bull put. Let's say I sold a 50 put on a stock and bought a 45, and the stock fell to 48. I can be assigned early at any time on that 50 put now, which means I'd own shares of stock at 50. Okay? Sure, I can sell them at the market at 48 if I catch it right away, but I can't exercise this long to cover the short. Why would I? Why would I want to get 45 back for the stock when I was put it at 50 and the market's offering 48? I've got to actively go sell it. Okay? If you hold it through expiration and you do nothing and the stock's between the strikes, you're going to end up long stock. How can this happen on a bull call? Well, it can't happen in that same scenario. If it's between the strikes, you are short the 50 call. It's out of the money. You won't be assigned early. But if you hold it through expiration thinking your broker is just going to sell to close the call for whatever value it has, they're not. They're going to assume you wanted to buy shares of stock. Same with a calendar spread, but you likely wouldn't hold that all the way to expiration. But you can be assigned early on the calendar spread as we just showed, or calendar put in reverse. Bear call credit, bear put debit. You may end up short stock for the same reason. I sell a 50 call and buy a 55 for my bear call credit, and the stock goes up to 52. My 50 call is in the money. I can be assigned at any time, which means I'm short stock. Now this would convert it to sort of a married call position. I can sell to close the stock at 52, sure, or buy the stock at 52 to cover the short. My apologies. I could do that. But I'm not going to exercise the 55 at this point. Why close it at 55 and take the 5-point loss when I can get 52 on the market? Okay? But it's very important. As basic as this seems, it's always very important. Even if you're doing a ratio spread, you have an obligation somewhere where you might be assigned early. It's a potential. You might have it structured so the long covers it. You might have it structured so the broker in most cases in a debit spread, bull call or bear put, if I'm assigned early on the short with the same expiration, the broker would likely exercise the long to deliver the short. But it does go that different way. Okay, if it's between the strikes or in a calendar, as we just saw, it may end up doing that. This also applies to iron condors and iron butterflies because you still have some short options in some position where you may be assigned early, and you have to plan for that if you haven't closed it yet once one leg goes in the money. Okay? So I'd just like to review that because it's as basic as it seems. It is so very essential to remember. You know your worst case scenario in a credit or debit spread, absolutely, but at the same time, remember you always have an obligation. Here's a listing, though, for those of you interested in calendars of what we did this year. Go to that webinars page, powerop.com/webinars.asp, requested topics. May 15th, early assignment diagonals, that's when we covered this. On May 8th, we defined calendar spreads, similar to what we did with the full series webinars on calendar spreads. And 5/21, diagonal or horizontal spreads and comparisons. May was clearly the calendar spread month. And that's because we did that webinar series at the same time on Wednesdays, discussing calendars, different types of calendars, structures, setups, and as well. September, we talked about in-the-money calendars. And on October 22nd, we talked about a poor man's covered call, which is just a diagonal spread. Why I don't like that term, but we also delved into that as well. Let's talk of spreads. Sam got some comments here. If you have shares, they will go away, and if no shares, you are short shares. That's right. So Sam's saying that if I ended up being short stock in that bear call credit spread and I still just held it to expiration, likely they would just exercise my long to cover the short, and I still just have the maximum loss. That's true. But remember now that when you get put the stock because of an early assignment in a spread, if it starts to move the wrong direction, you might lose on that long option and lose on the short stock position. Right? It's tricky, but you can lose both ways in some cases. Not likely, but you can lose both ways, but it still is important. All right. So discussion on management, discussion on what could happen, leads us to probably the most frequently asked question of 2018 is management of spread trades. And whenever I talk about management of spread trades, I always go first into trigger points. We had a lot of questions on managing debit spreads, credit spreads, iron condors, butterflies, in the money credit spreads, even more. I have hosted a separate webinar twice this year on managing bull puts and once on managing bear calls. But to me, the trigger points are the most important. Yes, we here teach 8 ways to manage a bull put credit spread for different situations, 8 ways to manage a bear call. There's 7 ways I teach to manage a debit spread. You lose one of those techniques that you can get in a credit spread based on the structure of the trade. Management can work and might work most of the time, meaning that the structure of a repair, the structure of a management will work most of the time if the market reacts the way you want to. When I repair a spread, I still need the market to do something. Very unlikely I'll be able to create a spread, create a repair where if the stock stays right where it is right now, it's going to work. If it continues the trend it's on against me, or if it reverses, I'd use different repairs in that case. Okay, but management can work most of the time, but not if you're near the maximum loss. Okay, if you've taken an 80, really I'd say a 70, 80, or 90% loss on a credit spread, a standard repair won't work. What do I mean by that? This is a 5-point spread we're showing again, just as an example. I used Ollie because we showed it the first time. Sold a 75 put, bought a 70. Say I got a 50-cent net credit for a 5-point spread. Hey, that would be an 11% return. That's about average for a 2-week, 3-week trade. And let's say when I did this, of course, Ollie would have been up at 82, 83. I'd been looking at about a 75, 80% probability the stock would stay above here. And then December happened. Okay, so it did get away from me. But when I open these trades, when I open any credit spread, bull put, even a vertical spread, bull call debit, I'm going to use triggers. I'm going to look to manage, adjust, or close this position if the stock reaches within 1% of my short put strike price. So if the stock was trading at 75.75, that tells me I need to get out of the way. It's getting close to a time when I need to get out of the way. What's going to hurt me the most as the stock continues to fall? This short option. The bear call would be reversed. If it starts to move up, what's going to hurt me most in the bear call? The short option. So if the market has turned suddenly and I expect it to go down, I'm in a bull put, I could just buy to close this put and leave the long open. In this case, that would have turned a profit for me. I could roll down one strike, roll down to the 72.50 for a lower potential return, but further upside. If I thought it was going to recover, in this case, it would have hurt me too. But I would have had less risk. Not 5 points down, only down to 250. Okay. I could have rolled the spread down, maybe, but if I closed this spread for a loss and then sold something out to probably February or March at the 65.60 strike, might have been okay, but if it falls further, that's going to lose too. Okay? Here's the problem. When it gets to this point, I'm taking a loss. I'm probably not taking the full loss. Let's say I'm taking a 90% loss. What is my max loss? I took in 50 cents on a 5-point spread, so the most I can lose is 450. Right now, I'd be at a loss of about 420. Can I just liquidate this spread for the loss of 420 and sell another bull put 1 month out and make back that credit? No. It's going to be another 50 cents or 60 cents. I could go out to January 2020, go out of the money to 60.55 and still not get $4. Not even close. I'd have to increase the strikes to almost 10 or 15 points, selling the 60 and buying a 45 to get 350 in January 2020. That's not going to cut it, is it? Okay, that's not going to repair it because the loss is too big. If the stock is between the strikes, I teach something called the pendulum adjustment, where I might take this put here, sell to close it, buy a higher strike put, and what have I done? I've created a bear put debit, which will be profitable as long as the stock stays below my existing short. I didn't move at 75. I've turned a bull to a bear with one move, one roll. But when it hits this point, you can't do it because everything in this range is trading at intrinsic. You can't get any gain back from it. And the net credit doesn't help. But when it's between the strikes, this still has a good time value. It's getting close to at the money. This is closer to intrinsic. So you're gaining some time value premium to swap it and convert the bull to a bear. But it doesn't work when it's all the way down here. And you could say, oh, well, you could create a butterfly at this time or add another spread to create sort of a reverse iron condor. Right. And now you run the risk of actually losing on two spreads. The repairs I teach are designed not to increase the risk or the potential to lose two directions or double the risk. I don't teach a repair that doubles the risk from where you originally were. Okay. So all I'm getting at here is that's why the trigger points to me are the most important aspect of management, because you can't let these spreads and these leverage positions get too far away from you, because then they're almost impossible to manage. Okay. Other discussions on this, including the full discussion on 8 ways to manage a bull put. Go to that webinars page, powerop.com/webinars.asp. Okay. And I'm sorry, click on the Option Strategies tab, and one of the first ones you'll see is 8 ways to manage a bull put, and discusses the trigger points, and you could just reverse those for a bear call. All right. In the requested topics section, places we covered, spreads. September 17th, let's talk bullish spreads. August 20th, managing bull put spreads, open interest, VIX Portfolio Hedge. Recently on December 10th, managing iron condors. Same way I'd manage one direction or the other, because an iron condor is a bear call with a bull put. And yes, Sam, that's why it's so important. Sam, of course, reminds us that vertical spreads, credit spreads, usually carry a 10-to-1, 8-to-1 risk-reward ratio. One loss is going to wipe out 8 previous gains. You're absolutely right. Which is why the trigger points are important, and not to allow anything, if possible, to get to that full loss. Okay? All right, but there were so many more favorite topics. We had multiple discussions, of course, on married puts, radioactive tradings, showing my trades and others. You can just scroll through that list in the requested topics tab at powerop.com webinars.asp to look for married puts and income methods. We talked a lot earlier on in February and then again in March on fixing a broken stock or a covered call that's moved against you. We talk about our stock repair tool, ways to manage the trade, and more. Okay, and so forth. Collar structures. We had a couple conversations on comparing collar structures, a standard collar versus a calendar collar, management techniques, and more. And come back to this later. On the YouTube channel, I took a snippet. It was the full webinar from October 9th, so you can check that out on YouTube. It's also posted, of course, on the requested topics page, comparing collar structures and other topics. But the first 45 minutes I clipped out here to this YouTube link. Of course, we also talked a lot this year about the risks of selling high IV positions, implied volatility range, and more. So you can go to those categories and scan for any webinars that contain the term IV, implied volatility, rank, or range as well. Okay. And then, of course, my favorite topics are really from you guys. The trades you guys shared, Sam, of course, Rajiv, Fernando, Paul, Mark J, JD, Victoria, Jamie, Rose. We had two different Dougs join us frequently, and then two different Johns, a J-O-H-N and a J-O-N as well, who joined us for those presentations also. So that was for some of my favorite topics because I just had to reiterate what you guys did and were sharing with us with confidence. And I didn't have to really give any insight. I just had to relate information and give maybe one or two thoughts on what happened. Now, I'm going to take a question that came in. All right. Mark says, what I had, Mark, was not a good example to illustrate this. I'll try to get one for us in a moment. But Mark says, on the pendulum example, don't you end up paying quite a bit to convert the debit bear to a debit bear put spread? Yes, but the idea was I'm in a bull put credit that's going against me. And Mark, if my sentiment is that the market's going to continue down, so in the beginning points of December, I thought we were recovering from November, I had a couple bull puts open, and then the market started to turn. I could just close and take the loss, but if I have the anticipation the market's going to go down, I'm going to do one of two things. I'm going to buy to close my short put, which is more expensive than the pendulum adjustment, but I'll buy to close the short put and leave the long open. Those would have all turned a profit most likely in December when my triggers were hit and everything started to go below its MACD negative crossover, go below its 20-day moving average and more. If I had bought to close the shorts, left the long open, they would have all likely been profitable, probably beyond my expectations as a repair. But that is a unique situation, isn't it? That was a steep decline. I would have had to held for an extra 20 days or so to take full advantage of that decline. Does it cost to do it? Yes. But as long as the debit that you pay to move the strikes is less than the new difference in strike prices you have in the debit minus your initial net credit, as the market falls, you still have a low risk of just the debit you paid in and the potential to still make a profit without paying too much money to just close the short or losing the 70, 80, 90%. All you've done is convert a credit to a debit. You always pay into a debit. It is going to be high, but when it's between the strikes, you usually get a good situation where you can do that pendulum adjustment and the debit you pay minus the net credit that you already took in is going to be less than the new difference in strike prices, which you get back if the stock continues down and stays below that short option. But you're right, just like any other repair, if it swings back up, you could be losing on the debit spread where your credit spread was profitable. That's the issue with any repair. You're expecting the stock to continue down, you make the repair based on that, and then it reverses on you real quick. It's a bummer, it happens, but you could lose on a spread that would have been successful anyway. That's sort of the chance you take when you do a management. Okay. Of course, I could say, hey, I think it's going to recover that way, so I'm just going to leave it alone, and it continues down. You take the 90% loss, you just wiped out 10 previous trades. So it's a trade-off. All right. So with that being mentioned, those were my favorite topics, and we talked about some of the other ones we didn't really discuss, but one obvious thing is missing. And despite, we're going to cover what Mark just mentioned in a little bit, Mark. I'm going to get to that in just a moment. Give me about 10 minutes, 15 minutes, Mark, and we'll get to yours. But Paul sent in an email today. And Paul said, recently I've been experimenting with short-term trades on SPY and some other underlying securities using long puts or strangles. Okay, kind of what Sam does as well, and kind of what I try to do also, but maybe just not as active as you guys are doing. Now today, you decided to use a bear put debit spread. Bear put debit spread